Hello, everybody, and welcome back. US equities have been closely linked to big tech for the past few years. But in the current market phase, it might make sense to think more about other segments again. Today, we talk to Bill Talbot about opportunities in US small caps. A warm welcome, Bill.
Morning. Thanks for having me.
Bill, the segment has weakened recently after a good start for US small caps in 2023. So what is the reason for the ups and downs?
Yeah, I think the primary reason cited, whether it be for small caps or for large caps that aren't among those magnificent seven that have propelled the large cap market, has been interest rates. I think that early in the year when US equity markets were strong, the expectation was that we were at peak interest rates and they were apt to decline. And instead, what we've seen is steady increases in rates since then, which has really created a headwind in the short term for US equity markets.
So currently everything seems to depend on the health of US economy. So what is your baseline scenario for the US market currently?
I think that I'm not an economist, but I do think that we're in late stage cycle, and that's how we've positioned our own portfolios. And I think there's a reasonable chance of a downturn, albeit shallow, within the next year. And that's just a normal cycle and something that ought to be manageable for investors.
Why is now an excellent time to look at US equities in this environment, and especially at US small caps?
I can really speak primarily to US small caps, and one is valuation. Valuation is small caps look extremely inexpensive in relation to large caps. One of the numbers I'd seen recently is that on a trailing PE basis, small caps are at about 68% of the valuation of the average multiple of large caps. And the last time we'd seen such an extreme divergence like that was all the way back in the TMT bubble in 2000. And if you had invested in small caps then, the leadership shifted to small caps for several years, and you were really rewarded for buying at what turned out to be a trough.
Your small caps have been much more volatile than large caps recently. Given the higher volatility, why should investors be willing to accept it?
I'd say they've been more volatile. Again, it's somewhat cyclical in nature, is that people tend to regard US small caps as more cyclical than large caps. And to the extent that the consensus is there is going to be some kind of a downturn, the flows have not been good into US small cap, and hence the depressed valuations. I will say that we think that it is overdone for the asset class in general, but also we measure our own portfolio in terms of the average upside for the stocks, and it's at an historically high level. So we think that there's a lot of gas in the tank for the small cap names that we have chosen to own.
You mentioned the topic earlier in this discussion. So what is the impact of the higher cost of capital due to increased interest rates on US small caps?
US small caps, when they do have debt, it tends to be bank debt, which in turn tends to be floating rate. So they've felt it inordinately, the small caps with leveraged balance sheets. It just so happens we regard ourselves as favoring quality small caps, and an important measure of quality for us is their balance sheets. So we tend to own small cap companies that have little or modest debt on their balance sheets. So it's been less of an issue for them.
Which companies are particularly affected and should be avoided at any case?
I think to the extent that we are a late cycle again and may have a downturn, we want companies that can self-fund their operations from internally generated cash flow. So that's an emphasis right now. We're sort of going back and scrubbing our valuations and looking at free cash flow and making sure that that can sustain a company through any downturn.
The lower valuations are repeatedly mentioned as a reason to invest in small caps. Are US small caps currently exceptionally cheap?
I think they are, certainly by the traditional metrics. But the narrative from the analysts on my team is as bullish as it's ever been. So for example, US small caps tend to be more domestic in terms of their sales mix than large caps. and are apt to benefit in the next few years from some of the fiscal stimulus, whether it be the Inflation Reduction Act or the CHIPS Act, reshoring or onshoring. All these are going to be additional tailwinds for small caps as well. So that's led us to be very bullish.
Why should the valuation differences between US small caps and large caps change in the foreseeable future?
I think that when people have confidence that rates have peaked and maybe have started to decline, and when we in the middle of or exiting a downturn, eventual downturn in the economy, again, this is when small caps really distinguish themselves. And when they do, when the leadership does shift to small caps, it tends to persist for years, not quarters.
What company qualities are you looking for in the current uncertain economic environment? And can you give some examples of companies that you like?
So, I mean, we're always trying to favor companies that are self-help. I think the metaphor is motorboats rather than sailboats that don't need macro tailwinds. Easier said than done, but we have companies that can grow for idiosyncratic reasons. You know, we're always looking for companies that really dominate or sometimes even define a niche.
This was Bill Talbot from Manulife Investment Management. Thank you very much, Bill, for being with us today and for sharing your views on US small caps.
Thank you.